If you own real estate or are thinking about buying real estate in 2025, then this video is for you. Today, I'm going to walk you through the top 5 real estate tax strategies to take advantage of in 2025. The One Big Beautiful Bill just passed Congress, has been signed into law, and as expected, it came with a ton of tax benefits specifically for real estate investors. So the first tax strategy for real estate investors is cost segregation. First off, IRS allows us to take depreciation over the life of the rental property. If you buy a rental real estate, usually you're depreciated over 27.5 years if it's residential. If you buy commercial real estate, usually we can depreciate the purchase price of the building over 39 years. This is what we call a paper write-off. It's something that reduces your taxable income. So what is cost segregation? Well, the IRS says you don't actually have to write off the entire building over 27.5 years. For example, you can do a cost segregation study where the components of the building are broken out on paper, and those components then can have faster depreciation. So certain parts of that building, we might be able to depreciate over 5 years, 7 years, or even 15 years. The shorter the time frame, the larger the tax benefit upfront. Tax strategy number 2 for real estate investors is bonus depreciation. This is what I consider a supersized version of that cost segregation. The One Big Beautiful Bill just passed 100% bonus depreciation, which means if we have eligible assets in our real estate, for example, the cost segregation we just talked about, then assets that are 5, 7, and 15 years, we can actually take an immediate 100% deduction on our tax return this year in the form of bonus depreciation. What does that mean? That just means more tax write-offs up front sooner rather than later. So rather than waiting 5 years to write off that building component, I'm gonna write it all off immediately this year. Now, if you already purchased rental real estate, something to be aware of is that 100% bonus depreciation only applies to rental properties that were purchased and placed in service after January 19th, 2025. You might be wondering why that date? Well, January 20th was when President Trump was inaugurated as president. So it just might be his way of saying, hey, you didn't elect me for president last time. So if you purchase property before January 20th, you have to use the old law. And that's not all bad, because if you did purchase your rental real estate prior to January 19th, 2025, you still do get bonus depreciation. You just get it under the old law of 40% depreciation. Now, for those of you who have bought real estate already after January 20th, what is super amazing is that whatever tax benefit you were expecting under the 40% rule now just more than doubled because it went back up to 100% bonus. The third tax benefit for real estate investors in 2025 is the qualified business income tax deduction, often referred to as the QBI tax deduction. Effectively, what this tax benefit does is it allows for certain types of income to have tax-free treatment up to the first 20%. In other words, if I make $100 of eligible income, the first $20 could be tax-free, and I may only pay taxes on the remaining $80. So the question naturally is, what type of income is qualified business income? Well, the good news is tax law favors real estate investors, so most types of real estate income are qualified business income. Examples include rental income, property management income. If you're a realtor and you're making commissions income is also eligible. Similarly, fix and flip and wholesale income, or if you are someone who's syndicating a real estate fund, those types of acquisition fee income also are qualified business income as well. This is an area that we often see it missed. So if you're earning real estate income, double check with your CPA to make sure you are taking advantage of the qualified business income deduction if eligible. The fourth benefit for real estate investors in 2025 that we can still utilize is the 1031 exchange. Basically, it's like playing the game of Monopoly, right? Where you buy properties and if it appreciates in value and you decide to sell them for a gain, instead of paying taxes on the gain, we can defer the taxes by doing a 1031 exchange, which means instead of taking money out on the sales transaction, we reinvest into additional investment properties. When we sell a rental property, there are a couple rules to meet when you do the 1031 exchange. The first one is within 45 days of selling your original property, you have to identify the replacement property or properties that you want to purchase. And then within 180 days of that original property sale, you have to close on one of those identified properties. Something really important to understand is you have to actually have an intermediary involved, which means you're not just going to do a 1031 exchange all by yourself. This is something that you will want to work through, first of all, with your CPA, right? Because even though we can defer the taxes when we sell rental property, we first want to know, should we do that? Do I have a gain? How much is my gain? Or do I naturally have other ways that I don't have to pay taxes on that gain? Once you've worked with your CPA and if they helped you determine there is a benefit to do a 1031 exchange, then you contact an intermediary who can then help you facilitate the process of doing an actual 1031. But this is such an amazing opportunity because it allows you to take accelerated depreciation when you own the real estate. When you sell, instead of paying taxes and recapture taxes, you can defer the capital gains by reinvesting into more real estate. And there's actually no limit to the number of times in your lifetime that you can do a 1031 exchange. So one of the generational tax strategies that a lot of our clients work with is this concept called swap until you drop, which means you continue to do 1031 exchanges until you pass away at death. And the benefit of that is when you pass away, your assets get what's called a step-up basis to fair market value. And the benefit is that your beneficiaries get to inherit the property at the current fair market value. So no one in the family pays taxes on the appreciation that you've built up in your lifetime. All right, number 5 in tax benefits for real estate investors in 2025 is energy efficient upgrades. There are currently credits for energy efficient upgrades, solar, but with the One Big Beautiful Bill, many of these are actually phasing out, some as of the end of 2025, some in the middle of 2026. So if you're looking to put energy efficient items on your home or specifically on your rental real estate, you want to make sure you're working with your CPA and your contractors to make sure these are done in time to maximize the tax benefit of some of these energy efficient tax credits. If you're a real estate investor or interested in real estate, these tax benefits can make a significant impact to your bottom line and help you to keep more of what you make. So be proactive, stay informed, and as always, be sure to like and subscribe and follow along for additional tax strategies.